Hello, my name's George Bell and I'm an investment analyst here at True Potential. Each month we like to bring you an update on the key themes we've been discussing when meeting with our sub-manager partners. And this month discussions centred around central bank monetary policy, US-China trade tensions and the different signals emanating from the stock market and economic data. The switch by the Federal Reserve to cut interest rates is an attempt to prolong the current expansionary economic growth cycle, and this dovish stance is expected to support risk assets. Data around economic activity, particularly industrial and manufacturing, has cooled, and financial markets are pricing in 3 interest rate cuts within the next 12 months. Our managers generally think 3 cuts is unlikely unless the underlying economic data deteriorates markedly. If a 0.25% cut turns out to be enough to stabilise growth, medium to longer dated bond yields are likely to push higher in the near term as growth expectations will start to shift up. For now, trade tensions are expected to ease, with Trump wary that further unrest may unsettle his chances of re-election next year. Recently, investment markets and economic indicators have diverged, equity and bond prices touching new all-time highs at a time when several economic indicators show signs of continuing weakness. This may be because the signal to ease monetary policy is reflected instantly in capital markets, but typically takes 12 to 18 months to have a meaningful impact on the real economy. In general, the investment outlook remains positive, with risk assets capable of moving higher. Recession probabilities remain low, and central banks are willing to play their part supporting the global economy. In an environment of policy loosening, risk assets offer the most attractive return prospects. However, a balance must be struck, hence adequate diversification remains essential to guard against the unexpected. This means having a range of assets, managers and styles. The True Potential manager partners are mindful of risk. They recognise that opportunities arise when asset prices ebb and flow. Diversifying into different areas of the markets means our managers can capitalise on volatility. Diversification also helps to manage liquidity risk. Investors expect to be able to get access to their money when it is needed, and if they can't, it comes as a shock. At the risk of repeating ourselves, advanced diversification is not solely about dampening volatility. It also always ensures maximum liquidity for investors investing in the True Potential portfolios. Let's look at some of the key themes our fund manager partners have discussed with us this month. US equities continue to be the preferred region despite generally lower earnings growth expectations for Q2. This occurs as the effect of the December 2017 tax giveaway starts to fade. US economic data, however, continues to hold up, with labour markets firm and consumers in rude health. Should the 0.25% interest rate cut in July come through as expected and trade tensions ease, this would provide a more supportive environment for forecasters to raise their economic growth estimates and be supportive of equities in general. Looking at emerging market equities, a trade truce between China and the US is helping generate positive sentiment towards the emerging markets, but a resolution is still some way off. Underlying fundamentals remain firm, and lower interest rates in the US are paving the way for emerging market central banks to follow suit by lowering their interest rates. A weaker US dollar will also help, but this is a difficult call to make. For now, improved economic growth across the emerging markets and developed economies will help support EM equity markets. It will also strengthen the case for buying emerging market debt, as credit quality should improve. The attractive yields on offer have made emerging market debt one of the best performing asset classes year to date. Japanese equities came more into focus last month, with valuations remarkably cheap relative to history. Investors like the valuation argument, but investor conviction around Japan has waned again. Global growth returning to trend or above trend levels would be beneficial for exporting countries like Japan. If this happens, it could be a catalyst for Japanese equities to regain some positive momentum. Looking at bonds, investors often look to long-duration bonds to help gauge the direction of the economy. Currently, they are not signalling anything for a stronger pickup in growth or inflation. Right now, the majority of our fund managers favour emerging market debt. Investors by default naturally drift to higher yielding assets such as emerging market debt when yields on offer elsewhere are at extremely low levels relative to history. And looking at styles, value underperforming growth has been evident throughout most of the current cycle. Our managers agree that valuations matter, and at some point value will come to the fore once again. However, knowing what the catalyst will be is heavily debated, as the sectors that comprise value respond to different factors and economic conditions. And looking at alternatives, alternatives is a generic term for strategies that do not fit into conventional categories, such as long-short, trend following, hedge funds, private equities, etc. They can be expensive, but in an environment where bond yields have shifted progressively lower and equity prices increasing faster than underlying earnings, they offer a way to enhance portfolio diversification should bond yields rise and equity prices fall. A number of these strategies have been disappointing, but they are needed most when prices are falling and traditional asset classes become unduly correlated. Commodities, specifically gold, has been a very strong performer over the past 12 months and has been favoured by our managers for its defensive and diversification properties. It offers a form of portfolio insurance against economic dislocation and tends to do well in low interest rate environments. It is for these reasons that gold serves its purpose in a multi-asset portfolio. Looking at currency, on balance the US dollar may weaken given interest rate differentials are expected to narrow. Furthermore, using purchasing power parity, a way to assess currency valuations, the US dollar looks expensive, especially relative to the pound. I hope this update has been helpful and I look forward to bringing you the latest developments in August. Thank you for watching.